Corporate Finance Presentation, Market Efficiency. Get ready, it's time to take your chance with corporate finance. Market efficiency factors. When thinking about the market, there's going to be a question as to how efficient is the market, and at any given point in time, how well does the price reflected on the market reflect actual value? There's varying perspectives on this from economics or in the economics world. So for example, in general, a Keynesian type of approach tends to think that the markets are going to be less efficient and there's going to be stickiness, and that's what allows the interference of the government, or what warrants basically an interference of the government to kind of smooth things out. From a classical standpoint, they tend to have more faith in the markets being more efficient and put more faith on the markets to basically drive things. Now that's a very broad overview. When we get into actual different markets, then we can have a similar argument in terms of different markets and say some markets might be more efficient than other markets. What are the components that can make a market more efficient or not? What are the components that can make a market run more efficiently, run more smoothly, reflect actual prices? And what are some components that may be inherent to some type of markets that will cause more stickiness and will cause more differences in terms of valuation to the actual price on the market? So we're looking at the adjustability of prices to adjust quickly. So that's one of the factors that will make the market more efficient. So the market needs to be able to adjust really quickly, and that's from a Keynesian standpoint. That's what they argued. Some places in the market are slower to make that adjustment, and that results in these differences within the market price and the actual value. If you're looking at a market that can adjust prices quickly, then you're looking at a market which will typically be more efficient over time, and you can be more reliant then on the market trends and what the actual market price is at a current time. When successive trades are made at a price closer to the previous price, it may be an indication of efficiency. So this is something that might indicate, right, efficiency. If you're looking at a market and you're seeing different trades that are happening, especially stock trades, because stocks are all the same, and if you're looking at them trading over time and the prices are somewhat constant, you're seeing nice even curves and not these sharp spikes in one place or the other, that's more likely that the market is efficient, because it's not like some new piece of information came out and the stock price jumped up or went down all of a sudden. The assumption would be that if we have a smoother rate of increase and decrease, that all the information is out there from a day-to-day perspective. That's what you would expect if all the information was out there and the markets knew what the actual value was and the price was reflecting the actual value. The ability of a market to absorb large dollar amounts of securities without becoming unstable is a sign of efficiency. This is one of the concerns when the stock markets get really big and you get these large capital influxes in it. The question is, well, can you have one of these big type of trades that are taking places, or large capital plays that are going on, without causing destabilization in the market? And of course, there's been questions over time about this because there's been speculation and whatnot. If you look at the market and you're saying, well, if some large amount of capital goes into the market, that could actually drive the market, right? You see people, of course, following the money, and if that's the case, then you're not really pricing things on value. It's possible that just the dollar amount could drive people's basically thought process instead of actual valuation. So we would like then the market to be able to absorb the large dollar amounts without creating these instabilities within the market, so that the market would still reflect actual value. So when there's more certainty about income, markets generally are more efficient. So this is going to be a question, of course, all the time, where they're questioning, if you're looking at equity type of stocks, when you're putting money in, the price is geared towards the future value that you're going to believe that you're going to be receiving. So you're trying to predict what the income will be in the future. Now, so if the income is going to be different in the future, and that could be resulting from many different factors, including the growth of the company and the speculative growth of the company, as well as regulations and taxes and all that kind of stuff, the more stable then the income predictions are going to be, the more stable the market is. If you have something that's going to cause a change in the income suddenly, such as a tax go up just all of a sudden out of nowhere, then of course that isn't priced into the market, and you're going to have these jumps that are going to be going in and out of the market instead of that nice even flow because the assumptions are not there. We don't know what's going to happen. So fixed income securities that have known maturity dates are generally reasonably efficient. So that includes things like U.S. government securities and bond markets. And that's reasonable efficiency is one of the reasons that you're typically going to have, more stable price, and they're usually having less risk that will be involved in it because, of course, when the endpoint is on that, and you basically have more leverage. If you're talking about bonds, U.S. government bonds, then everything's pretty well known. Everything should be pretty much priced in there, right? You know what's going to happen. You know what the maturity date is. You know what the interest is. What you don't know is what's going to happen, of course, in the market. If you have an instability in the market, such as inflation going up or something like that, or tax policy changing. So then we have our theories with regards to the markets, and these are just broad theories, and many people, you can think of this more as a spectrum rather than three kind of buckets that you'd fall into. But we have the highly efficient perspective, which would be that all information, both private and public, is immediately reflected in the market price. So if you had this perspective, this is going to be at the tail end, where you're saying the markets are highly efficient. You can depend on the markets. They have the information included, and you have faith then, if you believe in this at this side of things, or if you're leaning towards this side of things, you're basically saying, hey, look, the market price is usually a pretty good indicator. I have faith in the market price generally, and that could change again from market to market. Like when you're thinking about different markets, you might say, well, this market I think is really efficient. This one isn't. Possibly this one is interfered with in some way or another, which distorts the market. But this market over here, maybe it's a more pure market, or maybe it has characteristics to it that lend itself to being an efficient market. You might say with regards to that market, I think that the price is pretty well reflected of the actual value. Less efficient thought process would generally be prices current reflect all of the public information. So obviously, when you're talking about the public information, with regards to stocks, you can think about the information that's out there, including the financial statements. The public knows the general overview, the financial statement overview, and they can make decisions based on the performance. And they have pretty good faith about the financial statements, given the fact that we have all these regulations if they're on the exchange and whatnot, and they have to have audits. So that public information is pretty good. So this is still an area where you're probably saying, hey, look, there's probably people out there that know information that I don't know, possibly about government policy, possibly about internals within the company, within the management system, or what they think they're going to do, or their plans before they release the plans and whatnot. And that kind of stuff, if someone had knowledge about it, could distort someone's decision making. They could take advantage possibly of that knowledge. But reasonably efficient market out there, in that the financial statements are generally giving the transparency that we're hoping for, and so I have reasonable assurance about the market. I think markets work, but there are of course factors that aren't on the market in some instances that could affect a decision making process. Most people in here are probably in the situation where they're going to say, hey, I'm going to trust the market kind of in the long term to be reflective of the price. And most people probably are not going to be trying to get that insider information in order to beat the market, because even if you were to do that, you might be doing something wrong to do that, because you might be doing insider trading type of things in order to do that, because part of the way that we want to have markets be stable is to have all the information out on the market. So if people are somehow not doing that, they're getting information that's insider information and making moves based on that causes a problem, which means we might want to make that not legal or try to disincentivize that kind of process. But still pretty good faith. And then a weak form says the past price information is completely unrelated to future price, and the trends cannot be predicted or used by investors to benefit. So in this case, you're basically saying, hey, the market is not working. And again, you might be in this situation on a particular market. You might say, hey, I believe in markets, but this particular market doesn't work for whatever reason. Maybe there's been government interference with it. Maybe it's just a type of market that doesn't work well in terms of the markets. Maybe there's a monopoly that's going to be involved. There could be different factors. So you might still have faith in markets, but then say, hey, this particular market here is completely, I don't think it works. So notice that these theories, you can kind of apply them to markets in general. In other words, most people have a sense, do they like markets or not? Do you feel that markets are efficient from an economic standpoint? most economists would say, yeah, markets are pretty good. No individual could possibly manage the economy and know what's going on, right? You have to have markets. Most economists would basically say that. But some economists have less faith than others. Then there's questions of, well, this particular market has less ability and needs more regulation or this or that. And then there's the question, and that's usually where most people lie. And then you can apply those same questions to particular markets, right? You could say, okay, this particular market has a problem with monopoly, or something like that, or this particular market has a problem with government interference or something like that, or it doesn't run efficiently. So you can then apply the market principles, and then of course the question from a policy standpoint would be, how do we fix it? Do we remove the market completely, or do we try to put in place things that would take advantage of the market and make it basically more efficient? And from a company standpoint, then of course we need to take those into consideration with regards to our investment strategies, both with companies that we're investing in, as well as determining where we fit in terms of our price and valuation on the market as a company.